No, I'm not surprised. The market is being pulled and pushed by opposing forces. Sentiment at the moment is overwhelming what market signals are. Market signals are showing an incredibly tight physical market, but there's concern about whether OPEC will bring production back. There are concerns about where demand is going, and I think the market is still awaiting, other empirical data to have a big shift up. I think the likelihood of the shift up is much greater than one down by the time we get to July. But it's wait and see for a while when we get more data points.
Ed, with today's news, though, what level of escalated tension will we need to see between the US and Iran, or between Iran and other players in the region, for it to just overwhelm the supply and demand dynamics that you said are dominating at the moment? Would it need to be boots on the ground, that sort of thing, or what?
Well, I'm not sure we're going to see a major conflict. I think what the market really needs is evidence that inventories are drawing. I think there will be, by the time we get to this point in July, very clear evidence that inventories in the world, ex the U.S., are coming down at a very rapid rate, probably between a 1 and 2 million barrel a day rate. I think that's what the market needs. It needs very clear evidence that the market is as tight as the forward curve of Brent or Dubai crudes are showing that the market is tight.
Ed, it's Stephanie Link. I have a question for you about inventories. In April and May, we saw 33 million barrels of inventory build versus a 5-year average of 6 million, 5 to 6 million. So were you surprised by the inventory build? And what do you think it's going to take to see that wear down and to get to your conclusion by July to see a tighter market?
Well, one of the contradictions in the market is that we have very high frequency data from the U.S. and much lower frequency data from the rest of the world. The U.S. has a market that's in contango. WTI's prompt prices are lower than deferred prices. That's a sign that the inventory build that's occurring in Cushing in particular can't get out of Cushing, can't get to the Gulf Coast. So we have cross signals between the U.S. with high frequency data and the rest of the world where the data are lagging, but the physical data on the structure of Brent are quite strong. So I think what we will see eventually is a market where demand for crude between the end of last month, 2 weeks ago, and the middle of August, at the peak of summer demand, is going to see crude oil demand, crude oil refinery throughput, growing by at least 3 to 3.5 million barrels a day from where it was 2 weeks ago. That is a physical market that cannot be supplied. The U.S. can supply it a bit when pipelines come into play to remove oil from Cushing and get it to the Gulf Coast. We don't expect that to happen until the middle of the summer when demand is quite high. It should then turn WTI structure into strength, into backwardation, and reduce the spread between Brent and WTI, which is currently close to $10 today and probably will collapse to closer to $5 once those pipelines are put in place.